Whether you want to believe it or not, Fibonacci levels play a critical role in defining support and resistance levels when day trading, and determining support and resistance levels is a common problem faced by most traders. Some of the common methods to determine support and resistance include trend lines, moving averages, pivot points, or Fibonacci retracements. Today, you will learn how to determine hidden support and resistance levels using Fibonacci extensions. Fibonacci series incorporates several analysis tools on the basis of Fibonacci ratios and sequences showing geometrical law of human behavior and nature, which is also applied to financial markets. The Fibonacci study can be applied to identify possible support and resistance levels by studying Fibonacci numbers in various timeframes. Fibonacci extensions, also referred to as Fibonacci expansions or Fibonacci projections, are external levels that go beyond the 100% Fibonacci level. You may already be familiar with these important Fibonacci levels, like the 38.2%, 50%, and 61.8%. These are considered internal retracements that are measured inside of a specific swing being analyzed, but they are important Fibonacci levels that extend beyond the 100% level and where price action tends to react often, and these are what we call Fibonacci extension levels. A Fibonacci extension is drawn by joining 3 points, unlike Fibonacci retracement, which has just 2 points by joining the lowest and the highest points of a predefined trend and vice versa. Let's understand how we can draw Fibonacci extension in a case of an uptrend. You need to join the lowest and the highest point, and then after a retracement or a correction and the price continues in the direction of the original trend, the low of the retracement or the pullback would be our third point. For example, looking at this chart, the price moved from here to here, and after this, the stock moves in the direction of the original trend. So the first point to draw Fibonacci extension would be at point A. The point B would be here, and the third point would be here, at the low of the retracement. This will give you the probable resistance levels where the price may face resistance in the near future. Let's now consider a downtrend. In this example, you can see that we have a bearish swing in price from point A to point B before price retraces part of this decline. Once price has corrected to point C and then begun selling off again, we can go ahead and apply our extension tool, mapping the swing from point A to point B and then back up to point C. The most common Fibonacci extension levels are the 161.8%, the 261.8%, and the 423.6%. Other important resistance levels using Fib extensions come at 50%, 61.8%, 78.6%, and 100%. Fib extensions are a way to establish price targets and find projected areas of support or resistance when the price is moving into an area where other methods of finding support or resistance are not applicable or evident. If the price moves through one extension level, it may continue moving toward the next. That said, Fib extensions are areas of possible interest. The price may not stop and or reverse right at that level, but the area around it may be important. For example, the price may move just past the 1.618 level or pull up just shy of it before changing direction. If you are long on a stock and a new high occurs, you can use the Fibonacci extension levels for an area where the stock may go. The same is true if you're short. Fib extension levels can be calculated to give you an idea on profit target placement. You have the option to decide to cover your position at that level. It's important not to confuse Fib extensions with Fib retracements. So what is the difference between Fib extensions and Fib retracements? While extensions show where the price will go following a retracement, Fib retracement levels indicate how deep a retracement could be. Fib retracements measure the pullback within a trend, while Fib extensions measure the impulse waves in the direction of the trend. Let's look at some practical examples to gain more clarity about the concept of Fib extensions. This is crude oil in the weekly time frame, with one Fib extension drawn on the above chart to show the number of resistance levels identified using the above logic. At first, we noticed that the price faced a resistance at the 38.2 extension and saw an immediate sell-off. Next, the 50% extension acted as a strong resistance, and you can see how the price rejected that area almost to the pip. We then have a double top at the 61.8 extension level, again almost to the pip. On its way down, observe how the price stopped at the previous extension levels. This is powerful stuff, and it's a shame that not many traders use this tool in their analysis. Let's move on the stock market and analyze a downtrend on the ExxonMobil chart. Here is the weekly time frame. We have the starting point here, point B here, and the correction point here. The extension levels are respected almost religiously. We have rejection at 38.2 extension level, at 50% level, at 61.8% extension, and finally at 78.6 level. Also, don't neglect the fact that after the price rejected those extension levels, it stopped at previous levels, offering short opportunities for those who wanted to trade in the direction of the main trend. Here are other examples of Fib extension levels on different markets. So how to use the Fib extensions? You can consider entering the market on Fib extensions when the price reacts to a level. This could be a bounce or a breakout. If the price bounces from a Fib extension level, it is possible that price may be stalling or changing direction. In this manner, you might be able to pursue a price move to the previous Fib level. In some cases, you will see the price clearly breaking through a Fib extension level. In this case, you may consider a trade in the direction of the breakout and target the next extension level. Essentially, you would want to trade Fib levels in a similar manner to other support and resistance levels. The main difference is that Fib levels are considered hidden levels of support and resistance that are not clearly recognized by non-Fibonacci based traders. Regarding stop loss orders, as a general rule, you can place your stop loss at the next level beyond the one you are trading. In the case when the distance may be too far away from your entry point, then you can simply use a swing top or bottom that is closer to your entry point. Regarding take profit levels, in trading there are no certainties. We are dealing with possibilities and probabilities. It is important to understand that there is no such thing as knowing exactly how far a price move will go. You can always set a minimum target at the next Fib extension level. However, you will see that the price will very often move farther than this, so you have to evaluate the market at each level and act accordingly. You do this by taking into account other factors, such as volatility and average daily range, which can help you in setting logical take-profit targets. The more volatile the market you are trading, the more likely it is to generate bigger moves. Although Fibonacci is one of the most useful methods to analyze your charts, it doesn't provide an exact entry point rather than an estimated area of entry. Moreover, there is no guarantee that the price will reverse from any specific Fib level, and hence you should combine it with other technical tools as a confirmation. So use complementary indicators or patterns when looking to determine one or multiple price targets, because we don't always know which level the price will reverse from. However, This tool gives us levels to monitor. It is then down to you to use other elements such as confluence with other technical elements like trend lines, moving averages, indicator readings or price action to decide whether to trade that level. Traders may differ in identifying the swing high and swing low points from which the extension levels are drawn, so there is some subjectivity involved here. The best way around these problems is to practice and practice. The point is that there is no one right way to do it, but with a lot of practice, you'll make better decisions when picking swing points. Gradually, you will get a feel for the trend and the overall technical picture. If you got any value from this and learned something new, leave us a like to show your support. And also don't forget to subscribe and click the bell icon to stay in touch with new uploads. Until next time.